Hey everyone, me Kevin here. In this video, I'm going to break down exactly what HouseHack is and what HouseHack is not. So let's start with what HouseHack is not, but let's look at companies that might have some similarity, or at least from the outside in, look like they have something similar to do with HouseHack. So let's go ahead and start with a company like Invitation Homes. Invitation Homes is a company born out of the last recession. It is a company that owns over 70, maybe now 80,000 homes. Actually, I believe it is over 80,000 homes that Invitation Homes owns. This is a company that essentially receives billions of dollars in institutional and institutionally funded capital to park money into residential real estate. The model is pretty simple. The model is find properties that you could rent out. So it's homes, and then you rent them out. There's another company like this. It's called American Homes for Rent. Generally, what you find with these companies, which are publicly listed real estate investment trusts, is that they're not actually designed to try to get the best property in the best location or the best deal on a purchase. The goal is to allocate Wall Street money to housing. That's it. Now, that's not to bag on Invitation Homes or American Homes for Rent. There's probably a need to do that, and then there are going to be equally a number of people who say, yeah, that's nice, I get to buy REITs on the stock market and invest in real estate without actually having to deal with tenants and toilets. But then, of course, that's going to be balanced by people who say, oh my gosh, Wall Street should not own homes. Okay, well, this is Invitation Homes, this is American Homes for Rent. And generally what you find inside of these companies, since these are their own entities, are the substantial operating expenses of actually running REITs. So there are property management fees, there are the SG&A fees of actually operating the company, then you have acquisition fees, and as usual, there are a lot of fees associated with real estate. This is a very common model, and this is your real estate trust model. Some REITs, especially non-listed REITs and even some listed REITs, will operate under an 80-20 model, where what you'll find is you're really partnering with people who have put together some form of a group of real estate ownership. And this becomes much more important when we talk about syndicators. So let's talk about syndicators, and let's understand that, because in understanding syndications, you'll also understand what the 80-20 model is. So syndications, these are going to be your classic promoter figure at the top, and then anywhere between an 80-20 split to as much as a 60-35 split. A promoter is usually somebody who could gain investments from people and sell the product. This might be something like a Grant Cardone. That's one of your more popular promoters on social media. So there's nothing necessarily wrong with this. There's nothing necessarily wrong with this. The goal here is buy properties, rent them out, and have some kind of cash flow, yield, and an institutional vehicle for diversifying into real estate. Because think about it. It's very difficult for hedge funds or let's say the Vanguards of the world or the BlackRocks or whatever to diversify into real estate, because they're not going to go out and buy a bunch of homes themselves. Instead, they'll have an entity go do that. Syndications are usually designed to also buy property, and then the goal is to hold that property usually for about 10 years. And there's a really important reason for this. The reason for this is that 35% is amplified by the time value of money, in this case, appreciation for real estate. So the increase in value of real estate over time. This is very different from a REIT, because with a REIT, you own a slice of that pie. So if you buy a share of Invitation Homes today, you own a sliver of 80,000 homes. That's great. That gives you an opportunity, again, to own a managed product, tenants and toilets, without actually having to own real estate yourself. The benefit of that is you easily diversify across a portfolio theoretically, it's a lot easier because, I mean, it shouldn't even be theoretical. It just is easy. You swipe up on Robinhood. You're not finding a property, inspecting it, renovating it, dealing with tenants, none of that. Some of those benefits exist over here as well, and you send your money to a syndicator who then allocates that to real estate. And then they hold that real estate, and the goal is to sell it to somebody else over time. So it's buy, hold 10 years, then sell. That's where really the big profits come in a syndication. Usually in a REIT, what a REIT does, which is a little different, is they might say, okay, we need an additional $100 million. So what they'll do is they'll issue shares in the amount of $100 million. Now they'll raise $100 million of cash in exchange for $100 million worth of shares. With this cash, they'll go buy more real estate. So even though it seems like, hey, isn't that dilutive? They created shares. Yeah, it is, but they also then increase the real estate portfolio. So theoretically, you could grow the portfolio and have the same yield at just a larger number and have more shares for people to be able to buy without decreasing the value of each share because you're replacing each share you've created with more real estate. It's kind of like in comes another house, boop, oh, more shares come out. That makes sense. The value of the company is growing. In this case, a real estate investment trust, which is a corporation taxed in a tax-efficient manner. These are actually very good products. There are other partnership products you can use as well that probably will be beyond the scope of this video. Another popular one is the Delaware Statutory Trust. These are a little bit more like syndications, except they have some tax benefits, 1031 benefits. So there are definitely some benefits here, but you also usually have pretty high fees. Fees is really where you face a lot of problems in real estate. So let's come up with an example here. So let's say you're a syndicator and you raise $100 million. Your pay in a syndication is not based on how good of a deal you got. Your pay in a syndication, on paper, it's very simple. Of course, we could say there are marginal benefits of having a better deal. But on paper, your pay as a syndicator on a $100 million deal looks like this. 1% for buying the property, so $1 million. 1% of property management per year for 10 years, so that's $10 million. 1% to sell the property at the end of 10 years, so that's another $1 million. And now, when you sell the property, you're going to take the 35% of the appreciated gain. So let's say the property in 10 years sells for $150 million. Oh boy, I just set myself up for doing some funny math. Well, we'll do it together. Well, it's half of 35 is 17.5. There we go. Okay, good. So now we're going to take $17.5 million, and this is now the total compensation for the syndicate manager. The syndicate manager in this case has just earned $29.5 million in a 10-year period. That means they've averaged almost $3 million per year of personal income for themselves as the promoter for allowing you to buy real estate through their fund. Now, the theory is that, well, they're going to brand it better and then therefore it'll be worth more. But that's not how real estate works. Unless you're a hotel or some kind of landmark, real estate is valued based on cash flow. Now, you could argue that, well, our brand attracts higher cash flow for tenants, but you're always going to be anchored down by the principle of substitution in real estate. You can't have a $3,000 two-bedroom, one-bath apartment when houses are renting for $2,500. There's no way. It's not possible. So, you're always capped to some extent by what the market is, unless, of course, you want to sacrifice your credit and qualifying standards for your tenants, but then that can lead to more management headaches. So, the syndication model is actually really brilliant if you want to make a lot of money off of your investors. This is, in my opinion, a fantastic way to get rich off of investor money. And this is why syndications are really popular with people who have followings. You get a lot of people who are like, oh, I'm going to do syndication work. Of course, because you're literally working with the house's money. I mean, you could say, oh, I'm putting my own money into this deal. You put $20 million in to buy the deal with financing, to get financing on it. Probably be more like, usually you're going to do like 35% down. So let's go with $35 million you put in. Then you raise $35 million in the fund, or maybe it's $100 million in the fund, whatever it is, right? Depending on the size of the property you want to buy. Now you get your money out. You cash your money out, and you're basically taking these fees with none of your own skin in the game. And these are fees that you've disclosed to your customers. Most of the customers just don't read the fine print. So now, or run the math. So now what you have is you have a situation where what you've really democratized here is profit for the syndicate promoter. That's what you've done. You've made a syndicate promoter rich. If you really wanted diversification in real estate and cash flow, the tax advantage way of doing that is investing in a REIT. Now that sounds boring because people over here are like, oh, but a REIT's just a piece of paper. Yeah, so is your partnership interest over here. But they both represent physical real estate. You don't actually own the property here. You own a piece of paper which represents your ownership interest and claim to a piece of that property, which is exactly the same as a REIT. So there's literally no different. They're both, from the point of view of, oh, it's a piece of paper, they're both a piece of paper. They both represent your claim to some of the cash flows of those properties. The problem is a lot of, some REITs and all syndications, basically, that as far as I'm aware of, and a lot of the DSTs, they charge massive fees for basically buying real estate. Okay, so how is that different from HouseHack? Because you might be wondering, oh, wait a minute, I still don't understand in full what HouseHack does. And I will do my best to explain that here. And the purpose of having explained what these other companies do is to help you see the difference step by step. And there is no solicitation in this video. I'm not fundraising in this video. So I want to be clear there. This is not, to be extra safe. There's no prospectus I'm trying to refer to here. There's no funding I'm looking for from this video. And at this point, this is not something that is supposed to be deemed any kind of projection or forecast or whatever. This is just simply, here's an explanation of the model to try to make it easier for investors or existing investors, that is, or other people who are just curious what I'm doing to understand what's going on. Okay, there's one more company that we should talk about before we talk about HouseHack. Open Door. So Open Door, you know what, as well as maybe Fundrise. Okay, that would be a good one too. Fundrise. You can bang these out pretty quickly. So let's talk about Open Door. Open Door is a very interesting company. In 2021, they purchased about 21,700 homes, which is pretty incredible. That's a lot of homes. They also have about 2,000 employees. This is a company that's generated 2.8 plus billion in cash flow, operating cash flow, much of that, though, I will say, from selling properties, over the last year. 9 months, actually. This was in 9 months. In 9 months. They provide employment for 2,000 employees to some extent. Their goal is obviously to provide investors with profits. The downside with Open Door is it was SPAC'd at the top of the real estate, or at the top of really the euphoria cycle in the stock market. And so the valuation that was assigned to Open Door was absolutely ridiculous when the company came out. And now, obviously, the company is worth a lot less. So from SPAC value, they've gone down to about $1.75 billion in market cap. So they've lost a lot of money in terms of looking at their share price. In my opinion, there are a few reasons why this company has had substantial challenges. Number one, the quality of work that they do based on, I can say this because it's true and it's my opinion, every single Open Door listing I've been into, I've been disgusted by. I would never wish those properties on any individual homeowner. And I pity the people who buy open door properties. So I know that's really aggressive and that's really blunt. It's like, well, you're just saying that because you see them as a competitor. Fine. Then let's just be transparent and real about it. I don't like what they do, but you should make up your own opinion. Go to some open door listings and figure it out yourself. So quality is a really big problem here. The second thing is they are basically internet flippers. This is a really risky business to be in because you're subject to the market swings in the real estate cycle, which are actually quite frequent. The real estate market tends to swing on little 2 to 3 month cycles in the micro. In the long term, most people don't recognize those because they're not real estate agents, they're not in the industry all the time. But this becomes really problematic and challenging when you're trying to flip a property, and let's say Open Door buys a property for $700,000 and they think they can flip it, after putting 30 grand in for $800,000, then the market briefly moves down 5% or 40 grand. Now they're upside down after they consider their selling costs, fix up and repair, and they lose money. So flipping is extremely dangerous. Quite frankly, in almost every single market. Flipping was great in 2021 because everything was just going straight up. It was euphoria, it was stupid, it was insane. That I don't think is a very sustainable business model, but despite that, they still do a lot of properties, they have a lot of employees, and they produce cash flow, at least recently, as they've been liquidating some of their portfolio. It's possible that'll go negative again. It has been negative in the past. All right, so that's Open Door. So it's not really a fee-based model, it's a flipper. It's a flipper at scale, and I don't think they're doing very well. Then you have Fundrise that compares themselves to Vanguard real estate funds. And what they say is they charge 0.15% as an assets under management fee. Unfortunately, this is, or some form of fee, I'm not exactly sure how they label it, but they essentially compare themselves, and I think this is very rude, but they essentially compare themselves to a Vanguard fund, which usually when you look at Vanguard funds, what do the Vanguard real estate funds invest in? The REITs. Invitation Homes, American Homes for Rent, the home builders, because Vanguard's not going to go buy houses. They're going to charge you a little fee to allocate your money to all the different REITs that are actually doing the work. Fundrise says, oh, well, look, we compare to Vanguard because we charge 15 basis points, basically. But this isn't actually accurate because they then also charge you an additional 85 basis points in additional fees. So these are combined, I would call them your asset management fees. In addition to this, inside the income and expense statements, so the income statement is a big deal for each property. Inside the income statement for each property, you're also going to face other property management fees and obviously the normal operating expenses to run a property. But even before you get to this level, Fundrise also has fees for financing arrangements and for construction. Now you have to check essentially which fund of Fundrise you're investing in, but there are a lot of fees. Some of these construction and loan arrangement fees can be up to another 1%. Now I think it's really important to just actually read these documents and understand that Fundrise is trying to democratize real estate by making it accessible and comparing it to Vanguard, but the reality is totally the opposite. I personally think it's quite unreasonable for them to compare themselves to a Vanguard fund because their fees are substantially higher. And then, of course, we have property management segmented out, which we should not forget that when you have somebody like Grant Cardone say that property management is 1%, that's actually just an AUM fee. The actual income statement itself will also show property management fees because Grant Cardone isn't actually managing the real estate. He's managing the property manager of the buildings. Yeah. So there are a lot of fees, and there's a lot of risk in real estate. As you can see, a lot of companies are trying to find out or figure out how to make real estate work. And I'll tell you, it's hard. I've done real estate very successfully myself, and I believe I've figured out how to do it. So, This next explanation, I have to leave some things out, obviously, because I don't want to give away the secret sauce. But that makes sense. So let's talk HouseHack. What is HouseHack's goal? And what does HouseHack plan to do? Well, let's put it this way. HouseHack wants to buy fixers. Then we are going to fix them and rent. Okay? Then what? Now we have what I call a QP, a quality product. Now we take 50 to 100 quality products and we put them into a box. And now we allow people to invest in slices of this box. Well, wait a minute. You said slices. Is that like a syndication or a DST or a REIT? I mean, isn't that just the same thing? No, because here's where it's different. This investment vehicle will come with 0 AUM fee. So remember when Fundrise charged 0.15% plus 0.85%? Yeah, that's 0. Remember when Cardone charges 1% per year to manage the asset? Yeah, that's 0. Oh, okay. Well then you're going to charge 80-20 or whatever. You're going to charge, I don't think I fully explained what 80-20 was. So 80-20, 65-35. This is called, this is the investor's money. Oops. Looks like I came off the board there. There we go. Erase that. All right, there we go. 80% is the investor money, sometimes as low as 65%. And that would be of cash flow or appreciation. So it's both. Usually there's a hurdle. So you'll hear people say, oh, we'll offer you a 7%. If we make less than 7%, you'll get all of that. If we make more than 70%, we'll split the extra. So if it's, let's say, 17%, it won't be, but let's say it's 17%. That's an extra 10%. Well, then in this case, this manager would take 20% of that difference. This one would take 35% of that difference. And then if you have appreciation or liquidation event, you again, the promoter would take 20 to 35% of the appreciation, right? So that's the 80-20, 65-35 model. That's how that money is made. So what is our model? Well, the AUM fee is going to be 0. The split fee is going to be this. HouseHack gets 0. HouseHack has 0 asset under management fees. Okay. What about property management? What's HouseHack going to charge for property management? 0. What's HouseHack going to charge for construction? 0. So we should put PM, construction, loan, 0. What about buy? What are the fees going to be to buy the properties? 0. Not from us, at least. I mean, if we use another realtor, obviously, then that's an expense of the acquisition, but that's not what we're charging investors. Okay. What about when you go to sell the property? 0. Well, then how the heck does HouseHack make money? It's simple. It all starts with step 1. Buy good deals. If we buy good deals, so we create a win-win transaction for a seller who wants to sell to us, then there's enough value in the deal to where we can fix it up, rent it out, pay our OPEX, and create a vehicle for people to invest in, which then allows us to go back to step 1 and buy more fixer-uppers. So HouseHack retains property management and control of the properties, but is able to, through mini funds, sell the equity in properties to allow for the democratization of real estate. It allows people to actually buy real estate in quality areas with tenants placed and have 0 fees. That's the democratization of real estate. That's what HouseHack is creating. Now, there are challenges associated with this. As with any startup, startups contain risks. They contain people risk, they contain deal risk, they contain funding risk, they contain travel risk, they contain liquidity risk, right? If nobody's interested in your mini funds, that's a problem. If you need to travel quickly to make sure you can take care of all of your projects and scale them, but you can't for whatever reason, that's a problem. So we have to minimize liquidity risk. We have to minimize travel risk. We have to minimize funding risk. We have to minimize deal risk. We have to minimize people risk. All of that, at this point, is Kevin's job. It's not easy. But that's what HouseHack is. So there's a journey between now and then, and there's always a chance it doesn't work out. But I believe that what we're creating is a vehicle that will completely disrupt the real estate industry. And I don't say that to exaggerate what I believe. That is what I believe. I have to be careful because we have regulations that say you're not allowed to exaggerate. So I want to be clear. Some people are going to think that's an exaggeration. I don't believe that's an exaggeration. So I'm going to balance it by saying if I'm wrong, then it could all go to zero. But this is an example where I'm highly convinced venture capitalist, which we have raised, I want to be crystal clear about this, we have raised $0 from venture capitalists. Zero. Everything we have raised for HouseHack, which is in excess of $40 million already, is from our community. That's it. So I'm convinced that mainstream financial institutions or venture capitalists or otherwise are blind to the opportunity that we're creating. And that might be because people are looking saying, you're crazy. There's no way you can do this. You are going to fail. And that is a very real possibility. I personally think it's a very tiny possibility. But for the sake of proper disclosure, let's call it a coin toss. So, that is HouseHack. As far as the game plan going forward, the game plan going forward is simple. How many properties can we acquire at great deals to prove that this model works? Then, how do we create the infrastructure to be able to raise money for the quality real estate? And then will people be interested in diversifying in their portfolio into that quality real estate? It should be a substantially better deal than any other product that exists. In my opinion, it would be stupid to put money into a syndication, a REIT, a DST, whatever, that is not matching a zero-fee model, because I personally think it's a ripoff. Now, again, I want to be clear. Maybe the idea fails, and that doesn't work out. I guess then it wasn't meant to be. But this is my vision, and I believe it's going to work out great. So, thank you for watching, and we'll see you in the next one.